The Fed is lying to you. Yes, indeed it is. And that should not be a surprise to some of you at all. Because let's face it, the government has an incentive to fool the public around money supply and the economy. They have to be re-elected and everything to the public has to look like everything is under control and there's no need to panic. Well, maybe not panic for now. But if you haven't noticed already, we're printing a ton of money. And for all my modern monetary theory experts out there is no denial that printing enormous amounts of money and hyperinflation have negative consequences for an economy. We can at least say that for every single instant this happened in the past, in Germany, in Hungary, and even in ancient China. This time is different. Those are famous last words. And I don't want to go into detail about the effects of hyperinflation. I want to show you how the Fed is hiding inflation from the public in order to fool you to believe that it is not as bad as it actually is. So inflation is when the value of a currency is going down as prices of goods and services produced are going up, meaning you can buy less stuff with the money available to you as time passes. Hyperinflation is inflation on steroids. Basically, the value of a given currency devaluing so much that what you buy today, for example $400 worth, will cost you $10,000 tomorrow. And there is no reason for you as a consumer to save your money, and not any incentive for suppliers to produce, sell, and or conduct business when what they are selling today they could have sold tomorrow for a much higher price. This is why following hyperinflation usually comes extreme poverty. But how is inflation measured? Or more specifically, the money supply? Well, at least in the US, it is measured using M1s and M2s. So M1 money supply includes those monies that are very liquid, such as cash, checkable demands, deposits, traveler checks. Basically the money in an economy in circulation. M2s is money supply in less liquid in nature and includes M1s plus savings and time deposits, certificates deposits, and money market funds. So basically M1s are all the money in circulation by the public plus transaction deposits. M2 is M1 plus saving deposits, times deposits, and money market funds. So I get a lot of comments and people asking me, where's the inflation? And you might ask, where's the inflation as well? It is in the markets, real estate and Bitcoin. The stock market, real estate, and pretty much everything else has been surging the past year, which is called asset inflation. Well, in the end, inflation will always end up in the commodities and consumer markets. People do not buy stocks for the sake of owning stocks, but rather will at some point take profits and spend that money elsewhere. That flow of money from assets to consumer market and overall economic activity with money being earned, invested and spent is also known as velocity of money. And the velocity of money has never been this low. Savings in the form of cash in saving accounts have never been higher before the pandemic started. And the stock market saw the fastest recovery ever after such a crisis. Observing this, we can say for certain that inflation took place and continues to take place in the form of savings and the stock market. Now we get to the juiciest part of all of this. The Fed has removed counting savings in the form of cash in saving accounts from M2s, meaning money being saved in saving accounts, which is higher than ever, is not counted towards inflation anymore. And why is this important? Well, just like I said, the inflation we would normally experience due to increased money printing and spending in the consumer markets is being saved and invested instead. With the global lockdowns and pandemic, there's just nowhere else to go for large amounts of extra cash. This high level of uncertainty in the world causes people not to spend their money. Why spend money if a new strain will be discovered tomorrow or if you're being laid off again? It just makes sense for people to save and invest instead. The velocity of money has never been this low, even counting in the dot-com bubble and housing collapse. So what should you do with all this information? Well, I talk about this in my video I made before this one. I go over my sector rotation strategy, read the economic cycle, and make decisions on your investments based on the performance of different sectors, interest rates, and bond yields. Go check it out. But before you leave, please consider leaving a like and following me. And if you find my content useful, why not support me on Patreon in exchange for some extra content for my valued patrons? That's the end of my video. Be smart and take care.